or not. So no, I will go ahead and get started. We'll welcome everybody to our Q4 iDisruptor event. You're seeing John Kasner, our executive director, on the line for the NMTC. My name is John Karabias. I'm a vice president of growth and strategy for our cyber intelligence business at Jacobs. I'm also an NMTC board member, and I am the facilitator for today's event. Today's event follows up on our event in our new series called The Future of Everything, really related to COVID-19 and a number of the effects it's having across society. We talked in our last event about the future of work and trying to sort of organize and make sense of the complexity and uncertainty that COVID had wrought just a few months into it. We are now 9 months into this, and this event is really about what we've learned, in terms of the effect of it on, a wide variety elements of society, business, government, politics, et cetera, and we're going to get a window into all of those things, particularly in 2021 moving forward. We've got three wonderful speakers, a diverse group of speakers as well. Our first speaker will be Jake from JP Morgan, who's going to talk about a range of big picture macro issues, whether those are in business, the markets, politics. I think all of those are ripe for what we'll hear Jake speak about today. Our second speaker is Dr. Ethan Booker. I think we're all really excited about his story and the journey that they've been on with telehealth at MedStar, and Ethan has been at has been leading in many ways that effort for MedStar. And then finally, we'll talk to Stephen Jones. Stephen is a VP at JMI Equity and has really been active in the private equity markets, looking at technologies related to COVID, and will provide us a view on really the state of technology post-COVID in many ways. So looking forward to all of their thoughts today. Just to kind of set the table for today, I was looking at what we have learned for today, and perhaps some of the things I'll just mention here may help set the table for some of our speakers' discussion. So, The Economist magazine ran a big piece a couple of weeks ago calling this the fourth big economic shock of the 21st century. The first was the integration of China into the world trading system. The second was the financial crisis of 2008. The third has been the rise of the digital economy, and I think we're going to talk about how the effects of that have been accelerated by this. And now this is really the fourth one. Certainly as it relates to the U.S., as impactful as any of those, at least acutely. It's certainly a major. It's been a major event with a wide range of effects across the economy. Interestingly, a couple of statistics. I looked at a survey from ITAM with researchers from the University of Chicago and Harvard. This just signals the shift that's taking place. It's remarkable. In May of 2020, 2/3 of U.S. GDP was generated remotely. That is the largest shift in peacetime production techniques in our history. So we have now moved to generating the preponderance of gross domestic product remotely now, and I think that trend is certainly here to stay. It has wrought also disruption in our labor markets. so data from the Harvard Opportunity Insights Center. So we've got essentially from the start of the pandemic to October, we've got 2% fewer jobs paying more than 60K. We've got 16% fewer jobs paying less than 27K. So this has had a much more significant effect on things like blue collar service jobs, for example. And I think, thinking about how this continues to affect labor markets is one of the questions that we'll be addressing both economically and politically in time to come. And then I also looked at a McKinsey global survey of executives. What kind of effect was it having on businesses? And what we saw was that companies have dramatically accelerated the digitization of their customer and supply chain digital interactions by 3 to 4 years. The share of digital or digitally enabled products has accelerated by 7 years in accordance to this survey. And then finally, respondents are 3 times likelier than before the crisis to say that they are at least 80% of their customer interactions are now digital in nature. And just as an anecdote to close, I'm leading a cross-functional working group on the future of client engagement inside Jacobs right now, since the ability to have face-to-face in-person client interactions has just dwindled precipitously. So there's so many ways that this is affecting our businesses, affecting government, affecting different facets of our communities and within society. So this group is a wonderful group to discuss that. So with that, let me hand it over to Jake, who is a global strategist at JP Morgan Private Bank, to get us started. Jake?
Yeah, thank you. And thanks for that introduction. It really highlights a lot of the topics that we've been thinking through this year and then helping advise our clients on. Just to level set, I think, my role at JP Morgan is to develop a view of what's likely to happen over both the near term and the more medium term in terms of cross asset portfolio performance. And there's obviously a lot of inputs into that. And in 2020, there was too many inputs, in my opinion, because it kept me up at night and kept me thinking way too much about how they would all interact with other and where, the cross currents would lead. But really, I think 2020 will be studied for generations to come in terms of how the economy, financial markets, and policy interact. And there's a couple of very important things that have changed in 2020 that I think will leave lasting impacts. But where I wanted to start was just where we are now. And one of the things that I do in my role is my team and I write a weekly newsletter to our clients called Top Market Takeaways. And I'll give you guys a sneak preview of the note that's coming out tomorrow. But the narrative I highlight is that there's the tunnel and there's the light. Financial markets are increasingly seeing the light at the end of the tunnel in terms of COVID. But for humans, it's very clear that we're still in the tunnel. You can see the chart on the left. That's daily new global COVID cases still rising exponentially. When you read the news stories in places like El Paso, Texas, or North Dakota, and then increasingly in places like Chicago, there's very concerning signs for the holiday season in terms of COVID spread. It's still a very big risk. But the chart on the right shows you why financial markets can look through that. And the blue line is when a board of professional forecasters believe that a mass vaccine inoculation program will begin to be implemented. And the blue line just says before the end of the first quarter 2021. And you can see at the beginning of this crisis in May, when we really didn't know anything, that was the least likely outcome. That was viewed as very unlikely and probably too soon for any type of meaningful vaccination program to happen. You fast forward to November 19th today, and that probability has risen to 90%. So I think the news from Pfizer, BioNTech, and Moderna is really positive and really surprised markets. Most participants were expecting a vaccine to be something like 50% effective, so something like the seasonal flu vaccine, but 90-95% effectiveness really changes the game. So when you scan across global assets now, earlier this week, the S&P 500, the Dow Jones Industrial Average, the Russell 2000, which is U.S. small caps, all hit all-time highs. The materials sector, the industrial sector, the healthcare sector all hit all-time highs. Chinese stocks hit all-time highs last week. Semiconductors are at all-time highs. Onshore Chinese stocks are at all-time highs. 10-year treasuries are the highest they've been in the COVID era. Japanese stocks are the highest they've been since 1991. The list goes on about financial markets really doing well in the midst of a situation on the ground for you and me that's still very dire. But I just wanted to give a sense that markets are able to price in the benefits of the vaccine well before you or me get the shot in our arm and get back to a kind of normal life. So that's been an important dynamic to watch. The next dynamic to watch, and I think this is really important in terms of the economy and how the legacy of the coronavirus crisis will be felt in years down the line, is the importance of policy and the power that effective policy can have. I think if you think back to the global financial crisis, which is one of the shocks that John mentioned in the intro, I think if policymakers could do that over, they would have done a lot more. And the chart on the right really shows you why. The purple line is GDP growth, and the green line is personal income growth in the United States. And the gray bars denote recessions. What you can see is that recessions happen when growth slows and personal income follows growth. That's the way it has been. That's the way the economy works. And that's why downturns become self-reinforcing, because people get laid off, they save, they don't spend. That spending doesn't become another person's income, and that income doesn't get recycled into spending as well. So you get into a negative feedback loop. What Congress and the government did during the coronavirus crisis is they broke that feedback loop. They ensured that unemployed workers had more than enough income to get through the crisis. And this is from the CARES Act that was passed in March, which included augmented unemployment insurance and stimulus checks. So you can see the green line and the purple line diverged sharply. And that's why the economy was able to rebound so rapidly, and the markets were able to rebound so rapidly as well. The government broke the negative feedback loop. And now that they know that they can do that, it has implications for other downturns down the line. Now, what is enabling the government to do this is Fed policy, which is the chart on the left. Now, the Federal Reserve did what they always do, which is cut policy interest rates to zero during a downturn to try to stimulate borrowing and investment. But they also instituted an historic quantitative easing program, which is basically the Federal Reserve buying Treasury securities, which represent government borrowing, to fund the green line on the right. Now, it's not, it's very close to the Federal Reserve helping to finance the fiscal deficit that the federal government is undertaking to assure that the economy stays strong. They're implicitly doing that by keeping interest rates low. So really, they're working hand in hand to provide this very powerful policy support to help limit the scarring effects of the coronavirus pandemic. It's a fascinating dynamic, and it really only existed historically in wartime. And it'll be interesting to see if policymakers institute similar responses due to just your standard textbook economic shock in the future. The real rate limiting factor for how effective policy can be is inflation. To put it simply, the central banks around the world and the Federal Reserve existed to keep a lid on inflation. They were designed to make sure inflation stayed in check and prices weren't rising too rapidly, to make sure that there was confidence in the value of money, and that we didn't end up in kind of a hyperinflationary, Weimar Republic situation where the value of cash is meaningless. But the game has changed, and the game has changed for a lot of different reasons. The labor force is globalized. The digital economy is a real deflationary force. Think about how easy it is to check prices across different suppliers on the internet. so the real risk at this point is that we're in a disinflationary environment, or that we're in an environment where prices are falling. Because when you're in an environment where prices are falling, there's no incentive to purchase goods and services today. You'd rather wait into the future when they're cheaper, and that can lead to a negative growth outcome. So what central banks are trying to do now is they're trying to push inflation up to their targets. So on this chart, I've showed where the Federal Reserve would like inflation expectations to be. And you can see in the depths of the crisis, inflation expectations had fallen precipitously. And they've done a very good job at getting those inflation expectations to rise towards their target, but they probably still need to do more to get them there. And they're definitely not going to raise interest rates until that dark blue line is in that blue zone and has been in that blue zone for a while and looks set to stay in that blue zone. So the implication for us and for the world is that policy rates and cash rates are going to be at zero for years. Number 4, I think another thing that may permanently have changed is equity valuations. When we think about how expensive stocks are, the first thing that comes to most people's mind is a price to earnings ratio. How many dollars are you willing to pay for $1 of earnings this year from the stock market? And the purple line just shows that ratio. And you can see that it's the highest it's been since the tech bubble in the 2000s, when stocks were in one of the most notorious bubbles of all time and had a precipitous decline in the early 2000s. Now, a lot of people see this and say, well, isn't the stock market overvalued today? Stocks are just as expensive on a price to earnings basis as they were then. You know, that's fair when you're looking relative to their own history. The issue is you need to compare equities to bond yields, to the fixed income market. And you need to do that for 2 reasons. The more technical, theoretical reason is that people like me value equities based on the net present value of all their future cash flows. And when you discount all of their future cash flows at a lower rate, which is the risk-free rate, all of those earnings are more valuable. So the lower interest rates are, the more valuable equities are, number 1. Number 2 is a little bit more practical. Most people invest based on a very simple framework of 60% equities, 40% bonds. And they make tweaks on the margin to outperform given where they think they are in an investing cycle or where they think they are in terms of valuations. Right now, bonds are the more overvalued part of that portfolio. And you can see that in the chart on the right. What we've done here is we've taken the dividend yield of global equities and we've subtracted the yield on the global bond index. And what you can see is that the yield on global equities is almost 1% higher than the yield on the global bond index. And it's not, that suggests that the dividend yield that you're getting from equities is way more attractive than the yield you're getting from bonds. That's just the dividend. That doesn't include any earnings growth or valuation appreciation that you could get from equities. So when you look at it relative to fixed income yields, equities are definitely not overvalued. And in fact, they look like they're at similar valuations where they were in other periods of stress. So think the Eurozone double dip recession in 2012 and 2013, or the EM balance of payments crisis and commodity super cycle collapse in 2015 and 2016. So to us, it looks like even though equity markets are close to all-time highs, they're still more attractive than bonds on a valuation basis. Now, the reason why this is important from a COVID perspective is if you remember back in March, the Fed did something they'd never done before, which is institute facilities that enabled them to lend money to the entire economy. Before, they were the lender of last resort to the financial system. Now they're the lender of last resort to almost all of corporate America. That matters because the probability of default for the largest companies that make up a heavy share of equity markets has fallen tremendously, which means that as an equity investor, you're willing to pay a higher price because there's a lower risk of default and a lower risk that you'll go home with nothing. So we feel like we could be in a new normal for equity valuations given the interest rate environment and given the changes in Federal Reserve and other central bank policies. Finally, and this one's important especially for US-based investors. The value of the US dollar relative to other currencies is generally dictated by risk sentiment. when things are scary and the global economy is deteriorating, investors tend to flock into the United States. And they tend to do that because it's a port in the storm. It's a safe place to invest. The U.S. Treasury is the world's safe haven market. The U.S. dollar is the world's safe haven currency. So when people are bidding up dollars and putting their money in dollars, it usually means that things are getting a little bit scary. So that happened during the coronavirus crisis in March. The dollar got very extended and overvalued. But as the global economy and the global healing process progressed, the U.S. dollar started to weaken. And I think, if it really happened a lot after the election results came in that showed that Joe Biden had won the White House. Now, the reason why the dollar weakened after it determined that Joe Biden was the likely winner is because he's very likely to have a very different approach to foreign trade and foreign economic relations. And you can agree or disagree with how the Trump administration handled the trade relationship between the United States and China, but I think everyone would agree that it was pretty unpredictable and pretty untraditional. We have a feeling, and markets have a feeling, that the Biden administration is going to be the complete opposite. It's going to be traditional and it's going to be predictable. And what markets like is traditional and predictable. They like to be able to, and businesses as well, they like to know what the rules are, and they like to know when the rules are changing, and they like to know if they can invest and if they can continue with global commerce. So as this global healing process continues and as trade relations improve, we expect the dollar to continue to weaken. If the dollar continues to weaken, it'll be a sign that this global healing process is really taking hold. So I quickly went through those 5 big forces that we think are going to shape 2021. But I hope that I teased out some of the other factors that might have more permanent changes due to COVID. I think you're on mute, John.
There we go. Great, thanks, Jake, for your comments. A lot of important issues. We had some questions come up through chat that we will save for the end. As we transition to Ethan, perhaps one thing you may address is, now that interest rates are as low as they are, they continue to be near zero. That blunts the ability of the Federal Reserve during a recession to use monetary policy to as it normally would. Hopefully we're not going to get in a position where we would need to stimulate the economy, but it leaves us with less options. Do you see that as something being problematic? It's certainly it's certainly an interesting theoretical discussion taking place in policy circles right now. Jake, does your firm have a view on that? You're on mute, Jake.
Okay, I think I'm on now.
Yep.
Yeah, I mean, we agree. The interesting thing is, when I think back to last year, one of the debates we were having internally, and this is pre-COVID, remember, one of the debates we were having is, what else can central banks do? Their traditional policy lever is basically used up. What could they possibly do? And I think one of the things that really surprised markets is the Federal Reserve did an excellent job at responding to the crisis. The speed with which they instituted these new facilities was really shocking. And literally the day that they announced that they were in the market to buy corporate debt was the day that risk assets bottomed, March 23rd. I don't think it had anything to do with COVID. I mean, March 23rd, I was in New York City. I don't think there were 100 reported, confirmed COVID cases in New York City on March 23rd, but that's when markets bottomed because of what the Fed was able to do. I think as we move into the next decade, it will become a very important debate. And what we're hoping for is that fiscal and monetary policy work together to generate the kind of economic outcomes that are desirable from a policy standpoint. Because I think it's pretty clear that the central bank can't do it alone for the reasons you mentioned. Policy rates are already at zero. They're already forcing a lot of liquidity into the marketplace through quantitative easing programs. but they need Congress and they need the government to stimulate from the fiscal side. And that's going to be the more powerful lever as we move into the next decade. Now John's on mute.
Still muted, John.
There we go.
Yeah, so John Kasner, if you turn off the option around muting, I think both Jake and I had a problem doing that. We're not able to unmute, so if you just check that. So thanks, Jake. We'll now transition to Dr. Booker, who leads the MedStar Telehealth Initiative. Dr. Booker, thank you.
Thanks, John. See my screen and hear me okay?
We can.
Great. So as John said, I'm the medical director for the MedStar Telehealth Innovation Center, which is the sort of primary engine driving telehealth, sort of both understanding and operations at MedStar Health. Sort of in thinking about telehealth as a disruption, given the sort of charge that I was given about disruption, one often thinks that telehealth is a technology disruption, but it's not. The ability to communicate over distance using first phone and then video is actually pretty long-standing. The consumer technology is obviously a little bit more recent, but the founder of the Mayo Clinic was taking phone calls from his farm in Rochester, Minnesota in 1879. The ability to be a sort of remote on-call physician is by no means new. And the disruption was really related to a set of incentives on the patient side, on the provider side, and then allowed by removal of barriers and policy that allowed the disruption to happen. So telehealth's not about technology, but it certainly relies on tech. What we're going to do is kind of spend a little bit of time talking about kind of what we've done and how to think about the disruption of technology and telehealth. Most people think of technology and telehealth as the big fancy robot that comes to your bed screen and to your bedside and brings the doctor to you. The dotted red box is the video part of a workflow around telestroke. The vast majority of what you have to do to deliver telehealth is not about the video. It's about the rest of the stuff. And not unlike a switch to a car technology that relies on an electric drivetrain instead of a gas engine, just because it's a Tesla doesn't mean it has to drive on different roads or use different tires or have different rules around its regulatory environment. It has a lot of the same rules. It has a lot of the same conditions. The circumstances of its infrastructure, that is, plugs instead of gas pumps, is different. But the vast workings of much of electric cars and gasoline cars is the same as telehealth versus the sort of regular health system. A little bit about kind of the nomenclature of telehealth. Telehealth can kind of be divided into a handful of different things based on kind of who's receiving it and what the modality is. We think of things as B2C and B2B, the kind of common technology or terminology that people use for other things as well. The most kind of common applications of B2B would be what most people think of as telehealth or on-demand urgent care. That is, a patient's at home on their couch and they're using their mobile phone to see a doctor to get help with something. We, within our health system, do a fair amount of B2B as well to sort of allow efficiencies across and between providers, and some things which are asynchronous, both between providers and between patients and providers. The thing that most people will, if you ever watched a Major League Baseball game, back when they used to play baseball, you've probably seen an ad for Roman, which is an asynchronous delivery in which a contextualized form is provided to a remote physician who's giving a prescription. Whatever your ethics are about it, the reality is that falls in the category of telehealth, probably the most lightweight version of that. I've actually been doing telehealth since about 2016, and the questions that we were always asked by providers are, like, how do I do this? Are patients really going to go for this? How do I get paid? And can I do it from home? I think a lot of us, obviously just joining via a Zoom call to do this meeting, have begun to understand what one can do from home, and kind of how to do it. But to do telehealth, the parts in the middle, are patients going to go for it and how to get paid for it, really requires a set of competencies and infrastructure. That was the reason why we started a Telehealth Innovation Center in 2017. So that really rapidly brings us up to where we got to in March of this year. That gives us the response that we went through. From 2017 to 2019, we developed a lot of competencies. We kind of understood how to do things. We definitely did telehealth at MedStar going back many years, but we really spent some time kind of coiling a spring against a number of those barriers that I described. How do I get paid? Will patients want this? And whether doctors want to do it either. And then in March of 2020, that spring was really released, and we scrambled to be able to provide care out to our community. The team that I run in February was 8 people, and in March was 250. And going from an 8-person team to a 250-person team was a lot of the challenge that we had very early on. And we had an enormous response from the Georgetown University School of Medicine with medical student volunteers. It stood up a COVID incident command structure and took redeployed folks from all over our organization to begin to respond to what we had to do in March and April, and have spent the ensuing months really developing stability. Now that we've improved systems and leaned down to about 40. So that's still 5 times bigger than it was a year ago, but we've managed to stabilize quite significantly. As I said, we were doing telehealth, but in February of 2020, we did about 240 total visits to people's homes. And since that time, we've done about 530,000 telehealth encounters. So in some of our service lines, we've had a 4,000% growth in what it is that we do via telehealth, and recently went over 500,000 in terms of video visits to people's homes. This is kind of a snapshot of what it is that we've done for MedStar eVisit. That's on demand, like basically downloading an app to your phone, requesting a visit with a doctor, and seeing somebody over video. We rapidly increased from March, going from essentially less than 10 a day to more than 500 a day in March in terms of patient encounters. Came down to a steady state through May, through the last month or so, where we were seeing about 150 people a day. And in the last week have ramped back up such that we're now over 400 people a day through that platform as well. And you can see from the geography of this that it's spread out kind of throughout our entire area, clustered very much in DC and suburban DC, Baltimore City, Baltimore County, but actually a lot in Harford County as well, who come to us to get care and guidance and navigation. The sort of scheduled visit side of what we do was an important part of replacing the ability to come in to an office to see a doctor. As John pointed out in our intro, with 2/3 of US GDP generated remotely, and a significant acceleration of what we do digitally and remotely, there's still a fair amount of healthcare that has to be delivered in person. And people did continue to come to offices, but we pivoted a lot of our work remotely very quickly, and continue to do about 20% of the work that we do by video. There's some proprietary, somewhat sensitive financial information on the rest of this graph, which is why it doesn't have its bars on it. But what it depicts is the big dip in blue is the disappearance of office visits in the 3rd week of March. and a rise in orange of phone, and then in green of video. We had essentially never done this before, March the 23rd, and spun it up and got it created, and were able to recover the overall volume of patient visits such that we were matched for volume by the first week in July for the disruption we'd had in March. We're now at a point where the in-office delivery of care is about 70%, about 20% by video, and about 5% by phone. And we're actually above where we were pre-crisis in terms of the number of visits that we're doing for patients. That flexibility has also led to an interesting phenomenon that our no-show rate has decreased quite significantly, which is good for patients and also good for our bottom line. Another activity that we do is related to spreading out the expertise of a physician. This is a weeks-long snapshot of a bunkered emergency physician model. So this is it's actually multiple emergency physicians, many of them working from home, who are actually smoothing the care of a patient into our emergency departments, also providing consultations to our urgent care, and in the right setting, actually greeting a patient pretty much at the door at triage, understanding if their issue can be resolved quickly, and then discharging them back out the door. So we put 2,500 patients a week through this pipeline in which we distribute out the expertise of an emergency physician to multiple different areas. So a lot of what I've run through there is actually not terribly new. What it is pivoting the kind of work that we've always done into using a new modality by video. But some of the things I want to talk about next are a little bit more new. And one of them is something called connected primary care. One of the things that we recognize about the primary care experience is that because it's traditionally been focused in the office environment, a patient comes in to see their doctor, particularly if they don't have that much wrong with them, once or twice a year, meets them for 20 to 30 minutes, and in between that time may not actually be terribly focused on the things they need to be focused on. Anybody who's tried to pursue primary care or getting a new primary care doctor has struggled with access for that. And so the connected primary care model is one in which patients still absolutely come in to see their doctor in their office, but between those interactions have much more connection through both messaging, the request for video interaction, data monitoring, like remote patient monitoring, for instance, keeping track of your hypertension on a daily basis and having a team of folks associated with your doctor reviewing that information. And the idea is actually to create an experience in which the primary care interaction is much more longitudinal, much more data-driven, and much more in the patient's home. The world of telehealth is often also moving much more in the direction of other consumer technologies. We at MedStar have a couple of different chatbots that we use to do different things. There is a COVID symptom checker chatbot. I think I might be sick. What can I get some answers on? That kind of thing. And then we also do a lot of our laboratory resulting through a chatbot that basically will send out a message to you to let you know that your COVID test is negative, and then give you guidance about what else that you might need to go and do. So the use of AI in these chatbots, both augmented by a chat agent, whether that's a physician or somebody who's actually just helping you navigate, is a really exciting part of what we can do in telehealth. And figuring out where to put that AI and that chatbot in the interface between provider and patient is something that we're really interested in, to understand what's the right place for automation, and where do you need a physician or a clinician to really be engaging with people, so that you can be efficient, but that you can also kind of give people the human touch that they need. This is from my cell phone. As I said in the introduction, I'm an ER doctor, so even before COVID, I spent a ton of time doing telehealth. People texting me and saying, hey, Can you help me with this? Can you help me with that? Sending me gross pictures of their fingertips that they cut off with a mandolin. Like, those things are terribly dangerous. My best bit of advice is avoid a mandolin at Thanksgiving time. But this ability to sort of easily reach out and get access to somebody really shouldn't be limited to just those people who happen to have the cell phone of an emergency physician. And the experience of, I'm sure that if any of you have tried to navigate health systems, is very much one of, I bounce around, I ask my mom, I call a neighbor, I finally get my appointment, and then I sort of go in and they don't answer the question. You kind of bounce around quite a bit through that experience. And one of the things that's very exciting about telehealth, now that it's been sort of unleashed, is the opportunity to take that funnel that most people have in healthcare, where they bounce around through a non-clinical experience, that is an administrative experience of finding the right thing, and really taking the technology and flipping that pyramid on its head, and having the experience be an apex decision maker right up front. So instead of starting with a secretarial experience, you actually start with the doctor who can answer your questions and then hand you efficiently off to that pyramid behind the clinician, so that instead of bouncing around in a bureaucracy, you get handed to someone who actually knows what to do with you kind of right away. So the thing that I think that this would look like, the thing that I would propose as a disruption, is that the sort of website experience or consumer experience that most people come to now, and this is kind of an example of the landing page of MedStar Health, which is like, got a bunch of places to navigate and a bunch of things where you can click on and go. And if you're to find the thing that you want to find, you kind of navigate through this, is something that looks a lot more like this, which is, I come to my health system, and I'm presented with a very clean image of, this guy right here is my doctor. I want to talk to him, or I want to see him by video, or I want to make an appointment. I want to look at my records. I need to find something. I want to visit now, or someone's going to help me from a free text environment to figure out where to go and how to navigate me. And I think the experience of the last few months, this incredible rise that we've had in telehealth utilization, has familiarized a bunch of people with a different way to get care. And it'll be important for us to figure out how to respond to that challenge, to not just replace the current experience, which is fragmented and doesn't really work for a lot of people, and make it one that is smooth and that people can move through easily, now that we have an expectation of being able to engage so remotely for so many things. The healthcare experience is going to have to get better at doing that. The limitations to that continue to be about provider acceptance, whether doctors want to do this or not. Patient expectations, because many patients don't want to do this. And then very significant regulatory and policy things that are going to come up when the public health emergency ends. There are a number of waivers under which telehealth is operating currently, both for payment and for regulatory environment. For instance, licensing across state lines, payment from Medicare. Who can do telehealth? Is it just doctors, or does it include physical therapists and occupational therapists and all that kind of stuff? So there's still a fair amount of regulatory and policy things that need to be made permanent for the incredible experience we've had over the last 9 months to be an enduring one. I know I went through a bunch pretty quickly. Jake's presentation caused my head to spin because it's not my world. I imagine this caused the same. I'm happy to kind of answer questions, and we'll keep a good close eye on the chat as well.
Yeah, well, thank you, Ethan. And we have a couple of questions that we'll get to at the end. That was a really fascinating tour de force on your own journey. I've got a couple of questions that I'll reserve potentially myself to the end as well. So next up is Stephen Jones. Just as he may provide some overarching remarks on himself, but what's so interesting about the work that Stephen does is he's really has responsibility for sourcing opportunities for his firm to invest in, particularly around software, which is where JMI is in the market. So he has got a keen ear, to the street and really understands what's happening in the pipes of technology development and software. And I think we're all really interested to hear not just what's happening around technology, but some things that are happening around COVID-related technologies and how different software applications and digital technologies that he's seen are going to continue to scale or have an impact, across the economy. So, Stephen, with that, why don't I pass it over to you?
Great. Thanks, John, for that introduction. I assume folks can see my word wall of a screen here. I expect that you'll all have read it. Maybe just to add a little more context on me, and I'll kind of sit today on an agenda slide for most of the chat, but at JMI, we invest in North American B2B software companies. So if you sell software to another business, we're interested in investing. The stage is a little bit later stage, so we're not sort of an engineer and idea kind of investor. We're more companies that have product market fit, that have customers and revenue, and what they're looking to do is grow faster. That's the kind of company that's a good fit for JMI. And so to help you all level set sort of what we see every year, we speak to about, call it 4,000 to 6,000 companies over the phone every year, North American software companies. We go meet in a non-COVID time about 700 of them, and then we'll invest in a handful every year. And so we have a kind of unique perch in the world where we see how, what companies are doing well, what companies, how entrepreneurs are coming to capital markets and asking for funding, and how macro trends are playing out in small to medium-sized software businesses. That's the world that I live in and work in. To maybe put some numbers around it, we invest between, call it 15 million and 150 million or so in software businesses. And we're relatively flexible after that. So we can do sort of a minority investment where you give folks capital to move faster, or we can do an investment where you buy out a whole company. And if any of you have high growth, interesting software businesses that you'd like to introduce me to, I would always be happy to chat with them. So maybe just, on the topic today, I thought I'd hit, both what we see in terms of the styles of companies that are performing, that are seeing lots of demand. There's also some business model considerations that I wanted to touch on quickly. And, I can sort of pull out the crystal ball. I think we're all sort of guessing in terms of where we go from here, but we can talk a little bit about, what's next. But to start, I think an interesting topic, it may be interesting, especially for business people on the line here. Entrepreneurs typically, for many years, like the way that venture capital works is you show up at an investment firm, or they show up at your office, you stand, you give a pitch, you often do lots of dinners together. And, it's sort of a marriage. You're letting someone into your family. We use that analogy a lot. Maybe it's a little creepy, but that's sort of what it is. It's a really close relationship. And all of a sudden, we can't do that anymore, and it's been a very interesting time in the private capital market to facilitate these kinds of interactions and business relationships. I've met entrepreneurs outside and, sat far away from them to say hello. We've flipped all of our meetings to Zoom. We don't, generally travel outside of the region ever for the job. And the last thing I'd say is what we tell folks is references matter more now. You have to get on the phone and find out when things go well, what was your investing partner like when things didn't go well, what happened, you talk to 5, 10, people that have partnered with this person before. So it's changed a little bit, the way that we do things. I think normally we could kind of solve the culture fit issue by just spending lots of time together, but it's not always possible, or at least the Zoom time is, not always as high quality. Shifting gears a touch to the styles of companies, it sounds like the last talk would have been very relevant for this one. Digital transformation and future of work, that style of software, and I mean, Zoom is the most obvious answer, but there are many, many more examples of, whether it's virtual product demos, whether it's, telehealth to some degree, and I've sort of segmented out healthcare on its own. Another example would be, you think about manufacturing technicians that used to show up in person to work on a machine. Those folks, pre-COVID, we're already starting to shift to sort of a video remote session where a skilled tech would sit back. Someone else might, in the field might use a camera and show them. Now that sort of technology is taken off. The ability to do that work remotely is huge. The other style of company it's sort of obvious, but cloud software. If you think about 15 years ago, a lot of work that got done was done on a desktop server that required often to be physically, at the computer, or at least networked to a device to be able to do your job. That clearly doesn't work anymore. And so people just need basic cloud infrastructure. So if you're storing data, for your business, small business, whatever it is, it can't be on a local server anymore because you can't always have folks in office to access it. Healthcare, luckily, we just got a huge lesson on telehealth, so I won't claim to know too much about, much more than Ethan does about telehealth, but obviously that's taken off. There are other pockets of healthcare that have also done very well amid COVID. If you think about even just general clinical networks and clinical data exchange, the ability for clinics to get but like literal trials for COVID, but even more generally, trial results out and off to their partners. It was often a manual mail exercise. And as people all went remote, suddenly the clinical trial ecosystem has changed dramatically, and the need to be able to do all of it digitally has emerged. So that would be another healthcare example that's certainly done well. And, telehealth, I would just pause there for a second. It's one thing to say telehealth, and that means, doctor and a patient interfacing over the phone, whatever it is, over a camera. There's all kinds of nuances around, whether there's connected devices that matter, that need to be integrated into the treatment. Oftentimes, even the organization providing the telehealth. So sometimes there are telehealth solutions built for employers. There's telehealth solutions built for higher ed institutions. There's a range of sort of vertical flavor of that is frankly all those companies have succeeded amid COVID. It's something that I haven't heard talked about a lot on this call. Well, I guess the China relationship certainly counts in this, but supply chain technology has done very well in COVID. And if you think about what that means, that it's one of the most underinvested parts of the enterprise is the ability to see and have visibility into what your international trading partners are doing without actually picking up the phone and calling a factory, in Indonesia and asking them, how's it coming? That is sort of the way that business got done in terms of international supply chain, even, up until very, very recently. Instead, now there's tons of investment going in to figure out early when your trading partners have gone down. So if my supplier all of a sudden has a COVID outbreak, I might not know until I miss a shipment a week later. And that doesn't work. And so you need portals, electronic cloud portals, to exchange information at a much faster and easier clip than historically. Another theme we've seen is, emergency and disaster management. Obviously, lots of folks are scrambling to buy software. And that's everything from as simple as say like a residential apartment building needs texting software to say, we have a case in the building. Or we are entering a new phase of recommendations from the CDC. So we recommend that you approach the building differently than you did previously. So that, the ability to communicate and effectively administer emergency and disaster policy is huge. I'm sort of ripping through all this stuff. It's fascinating. And I would say that there's just tons of nuance and interesting things emerging. But I'll pause on sort of the industry side of it. The one other thing that I wanted to talk about a little bit, just in terms of what has done well, the ability to sell, implement, and support your software remotely, it turned out to be a huge asset. So if you think about what that means for a second in B2B software, if I'm selling a really large planning and accounting system that requires me to come to your site to take a bunch of data out of your on-premise servers, put it into a new implementation, it requires networking with your existing network. And frankly, sometimes it even just, like from a sales process, I'm sitting with lots of enterprise sales reps who only know how to go out into the field and sell. That model was put under strain. And what the model that did much better from an enterprise software business model was that allowed customers to come to your website, download the software, and buy it without ever you having to get on the phone or go to them to do it. The classic example of this is a company called Atlassian. Atlassian sells developer tool software, and they sell to huge organizations, but the way they do it is they sell down to an individual developer who downloads the software, uses it, and for them to be able to share the results of what they're doing, they have to get their peers to download the software. So you get this almost sort of network or viral effect in companies that sells the software, and there's not an enterprise rep showing up and taking everybody to dinner and all these other things. That's sort of the old model of selling. So then, like I said, the last piece here, and apologies, I'm sort of ripping through here, but I'm happy to talk more in Q&A. What happens next? This is, I think, all speculative. There's no one knows. To me, the framework that I've used and thought about this from an investing standpoint is, what is an accelerant of a trend that is already existing, from a technology and innovation perspective? I thought, one thing that went by earlier, and I believe it was John that said it, was talking about, we moved ahead 8 years. There are certain industries like cloud adoption where the move to the cloud infrastructure, cloud software, that's a mega trend in software that is, we're probably a third of the way through, maybe less than that, quarter of the way through. That's accelerated, but it's not going away. That's a trend that, everything is moving to remote servers, and that's a very, you can imagine that's there to stay. Where it gets more interesting is, and I think too, by the way, like, digital or telehealth is probably, to me, the most interesting. And the question is, if you think about, in-person interactions that are hampered by, and this is where Ethan could probably help me, but there's probably a range of efficacy. And we've heard this, there's some sort of treatments and patients where it's, remote's, in some ways almost better for everybody. You save time, administrative overhead, and the care is just as good. But obviously, if there's specialized equipment required that, you're not going to, your options are to try to take it. You could have a tech take it to the person, leave it on their doorstep, or, when there are things that need to be administered, I think telehealth, pre-COVID, during COVID, post-COVID, is going to have limitations that ultimately, right now there's sort of a band-aid of using telehealth to try to figure it out, but probably the models will need to evolve. Another example of this would be like event software. Event management, there will be live events in the future. Like, we can all agree that's coming back, but right now virtual event software is what everybody needs. And so there's probably lots of that software being bought, and the use cases are going to evolve in a post-COVID world. So those are a couple examples. I'm ripping through partly to keep us on schedule, but I'll pause there and hand it back to the panelists.
Sure. Great, Stephen. Another fascinating discussion, as rip-roaring fast as it was, and that's evidenced by the conversation I'm seeing here on the chat. So thanks, Dr. Boker has begun addressing some questions there, but why don't we get right to some of the questions from the audience. I'll start at the top and work my way down. Jake, if you're on the line, we've got a investment crystal ball question to start with. The question is from the standpoint of a new or someone who is a newly retired individual. So think of that persona. This individual is wondering, is it safe to stay aggressive? That's their question. It's pretty general. Feel free to answer it however you'd like, Jake.
Yeah, I mean, so the first thing I'll say is that, your portfolio should first and foremost be dictated by your goals and what you want the investments to do to you. It's hard to contextualize the insight and the view that we at JP Morgan have without first understanding, what your money is and what you want it to accomplish. I think I don't have, any understanding of the balance sheet or the investment portfolio as it stands of the recent retiree. Congratulations, by the way. But generally the thinking is that you should be taking down risk as you move towards and then into retirement, because presumably you've invested for the goal of having a nest egg to retire with and having that income to support your lifestyle when you're not earning an income. So as a general matter, we don't think that most retirees should be aggressive in their investment portfolios. Now, there's parts of your portfolio, if you plan well and you have, you've set aside enough money for your goals that's invested more conservatively and you're fairly certain that it's going to be able to support your lifestyle. You might have another bucket of money where you can stay aggressive and you can find tactical opportunities and you can trade. But it's really just, it depends on your goals and it depends on your personal balance sheet and what you want the money to do for you. We have a positive outlook on markets and the economy, into 2021 and probably beyond. But that's not the most important thing. The most important thing is, what do you want the money to do for you?
Let me ask a follow-up question to that related to the new incoming Biden administration.
Yep.
You just mentioned you guys are forecasting into 21. I'm wondering, what effect, whether that's, there could be changes to tax policy. I think there's a hope that there could be greater liberalization of trade. Perhaps we'll get an infrastructure bill, although I think we still have a divided Congress, so the ability to effectively legislate is in question. But are there any, perhaps clear things you guys can take from a Biden administration that you can talk about may have an effect on in 2021 in terms of broad macroeconomic effects?
Yeah, I think generally our perspective is that elections matter in the near term, but over the long term, it's the business cycle and it's the economy that drives markets. You can slice and dice market returns based on, who controls Congress and the White House any way you want, but the results all turn out basically the same because, the market has an average rate of return. It's based on the growth of the U.S. economy and the global economy. And it's been a pretty good generator of wealth over the years, regardless of who's in the White House and who controls government. I think where the Biden administration is a positive catalyst is areas that we were positive on regardless. And the Biden administration is just an extra kicker. So I think, Asian equities and emerging market equities broadly are an area that we're marginally more positive on, given a Biden administration. And that goes back to the argument around trade. And then the second area is sustainability and renewable electricity generation and clean technology. It was happening anyway. I was on a call today with a leading private investment partner in the renewable space. And this made it so clear in my mind is that, there's never going to be a coal-fired power plant built in the United States ever again. And there's probably not going to be a gas-fired power plant built in the United States ever again either. So sustainability and clean tech is happening, and it's just a matter of time, and the Biden administration will probably be an accelerant. So those are two areas where we had a positive view anyway. The election outcome made us marginally more positive on that.
Okay. And another audience question, kind of two here, but they're related, Jake, and that is, one, what would the impact be if the Fed stopped being as sort of active as it has been? And then from a fiscal side, if Congress does not pass a follow-up to the original CARES Act either later this year or early next year, what effect do you see that potentially having on the economy?
Yeah, so I think, this question brings up both of the two biggest risks to our view, I think that there are. We expect policy to remain supportive, and a reversal of that would change our view. There's probably enough momentum in the economic recovery already for us to, even if we don't get another fiscal stimulus package in the first quarter of 2021, we don't think that would cause any kind of double-dip recession, but it certainly wouldn't be as good for the economy and for those acute areas of pain that are still being, severely impacted and restricted by the COVID crisis. So think leisure and hospitality, travel, energy, et cetera. The fiscal side is one thing. The Fed, and this gets a little wonky, and I'm sorry, Ethan, I might make your head spin again as I get into this, but I'll try to explain it as clearly as possible. The farther out in the future your cash flows are, the more lower interest rates help. Okay, so the reason why a lot of these big secular growth technology companies have done so well this year is because investors are able to put a higher and higher valuation on their long-term cash flows. If the Fed stops being as supportive, it means that interest rates rise. So as interest rates rise, you have to write down the value that you were putting on those secular cash flows because you have a near-term competition for your capital. If you can get 2% on your cash, you're less likely to lock up your money for a return that it might take 30 years for you to make it back. So if the Fed was less supportive, it would have impacts on the economy, but it would also have a big impact on the stock market, just given that it's very sensitive to moves in interest rates, given the weights of these, large mega cap secular growth technology companies.
Great answer. And Jake, let me ask one final question for you before we pivot to Ethan for some questions. And that are, we've seen the FANG stocks, I think, increase close to 60% or so since the beginning. It's clear that, digital and even a small amount of digital driving the Dow, a small number of those folks. And I think more broadly, we're just seeing trends where the returns to scale and technology, or the returns to folks in white collar jobs through this whole thing have diverged even larger than they are. So what are your thoughts on the ability to see more broader, more well-dispersed economic growth moving forward? And are there any policy things that could be done to turn around what are some long-running and increasing trends, fissures really in the economy?
Yeah, I think, it's a critical point, and, thanks for reminding me to talk about it. It's, this COVID crisis has exacerbated inequality, and it's as simple as saying, a person like me who works for JP Morgan in finance, I can work from my apartment because I have an internet connection and a computer. So I don't have to go anywhere. I don't have to put myself at risk, but a lot of lower paying jobs where you have to put yourself in a high contact social situation, it's incredibly dangerous. And, I think that it's powerful and it's meaningful. And then if you, to your point, it's exacerbated inequality within the markets and in terms of wealth, because, the top 1% owns a staggering share of the public equity market, relative to other wealth quintiles. And their wealth has really done spectacularly well during this crisis. I think it all comes back to fiscal policy and labor policy. If you don't get that fiscal support package from Congress, what happens is growth is more scarce. It doesn't broaden the growth. And the simplest way to think about value is supply and demand, right? So when you don't have as much supply of things that are growing and things that are doing well, the things that are growing become all the more valuable. So that's why you get massive increases in the value of things like Microsoft or Amazon or Salesforce, or NVIDIA or Tesla, because those are the only things that are able to grow in a restricted growth environment. To broaden out the returns of the equity market and in the economy, you need another fiscal relief bill, and you also need a vaccine that can work. So I think those two things are critical. In the longer term, I think what is going to matter for the economy is labor bargaining power. When you think back to those shocks that you talked about in the Economist article, there's a pretty clear correlation of returns that come to labor plummeting with China's acceptance into the WTO, and it goes back to the idea that when you globalize supply chains, you're increasing the supply of labor massively, and when you increase the supply of labor, there's more competition for wages, and wages go down for everybody. So it's not literally that China took our jobs. It's just that it made it a much more competitive global labor market, which means that wages are going to be lower for everybody. So it comes down to labor bargaining power, and then ensuring that the United States is still the center of high value add manufacturing in the world.
Great answer, Jake. Thank you for that. Ethan, I know you've answered a couple of questions, but we've got quite a few entrepreneurs and others on the line who are doing work with the federal government in the areas of virtual reality and augmented reality, as you saw in the chat. Do you want to opine on those two topics in terms of their application, to telehealth and medicine more generally?
Yeah, I think there's actually a couple of interesting things in there. And actually, I want to respond just briefly to some of the stuff that Jake said, which is, I actually have the strange situation of actually sitting on both sides of the working remotely and working in person, because most of my job is as a telehealth sort of administrative leader, and also sometimes delivering telehealth as a clinician. But once a week, I'm working in my urban emergency department in the middle of downtown DC, right? So I split the fence between, working from home on Zoom in my basement and putting myself in one of the higher risks environments that one can be in. And so I certainly have a lot of sympathy for those folks who need to go out and be sort of out engaged in all day, every day. And I certainly have more protections than a lot of them do. Your specific question about AR and VR, one of the neat infrastructures that we have in place within the MedStar Institute for Innovation, where my telehealth group sits, is Cytel, which is a simulation and training lab that includes a number of folks who are directly VR programmers. So we actually do a fair amount of our simulation and training in VR and in AR as well. And I think the applications of augmented reality into the patient-provider experience are really interesting. I actually, the quickest way that I see that happening is actually more along the lines of augmenting the provider-patient experience more directly, so that patient-provider are actually in the same room, and you're using AR to layer in information to make that experience richer. But I do think that there are some opportunities to layer in some other things as well. There's some nice therapeutics that are probably available that are some of them are VR, but sort of guided meditative therapy that includes some haptic feedback is a really interesting one that I have seen in managing certain GI discomfort. So there is some stuff in that space that's already pretty interesting, and I think will probably be a continued growth area, even into the realm of digital therapeutics through specific VR, AR programming.
Sure. And how about, Dr. Booker, in terms of artificial intelligence, the ability to assist you in decision making, help provide training? You mentioned chatbots, which oftentimes have an AI algorithm at their root. But are there other interesting applications that you're seeing around AI in particular that you think could assist in delivery, diagnostics, all the things that would be relevant to you?
Yeah, as I mentioned, I think that's a really interesting space about where should the AI be in the interaction? Should it be the primary point of contact to a patient, and then you get to a provider second, or should the AI be behind the doctor, kind of supporting them in their interaction? My preference, and maybe I'll just bias myself because I am a doctor, is I think the doctor should be first and the AI behind them. But I think there's actually, what we know already from protocol-driven guidance is that AIs are actually better at following protocol. And if the protocol is sound, then outcomes are better. Right now, if the protocol is not sound, or the learnings are not sort of well-founded in previous outcomes, you run the risk of not doing as well. But an AI will be better at making sure that patients are getting the right therapies or doing the right diagnostic testing or all that kind of stuff if it has the right set of inputs. And that works really well in a chat environment. In an in-person environment, it's not as good because AIs are lousy at telling whether someone's lying, or at least not telling you the full truth, which you kind of still need people to do.
Yeah.
One really interesting thing that I think we should be exploring is there was a really cool set of studies looking at the engagement of Black men with hypertension in an area around San Francisco, and demonstrated that their outcomes were considerably better when they had the option for choosing their doctors, and they chose Black doctors to take care of them. So I actually think that there may be opportunities to use AI to remove provider bias out of experience, because if the AI doesn't have a race or a gender or come with that bias, there's an opportunity for that experience to be better. So I think there's some really interesting areas to explore around that that I think we'll be looking into. I want to answer one question for Stephen, which is about blockchain. So there actually are some companies doing blockchain for healthcare credentialing. I don't know if Stephen, if you've run across these, but healthcare credentialing is a pain in the ass. But basically what it is me as a physician, what's my education, where do I hold licenses on my ongoing medical education, what insurers do I have relationships with that I can bill against and stuff like that. And so it's really good. Blockchain's a really natural fit. That distributed ledger technology is a really good fit for healthcare credentialing. Both physicians and nurses often use credentialing, and it's already a pain in the ass, and blockchain could potentially make it a lot better.
Dr. Booker, and before we hand over to Stephen, just a final question, putting on your crystal ball. Again, you mentioned briefly that some people seem to like telehealth, some people don't. So perhaps a thought experiment here. Let's assume that legislatively everything worked out and telehealth was allowed to remain in perpetuity. What is your sense of perhaps the demographic differences? My experience has been, teens live their lives through digital. It's become very natural, whereas the older populations have a different experience. So perhaps taking into consideration those changes and the view of the doctors and your desire to continue delivering service this way, if the pathway was established for you guys to continue delivering in this fashion, what are your thoughts on this as a viable model from a consumer perspective and delivery perspective to continue delivering health this way?
Yeah, I think it's going to settle out somewhere, in the non-trivial range, and it's going to vary a bunch based on the type of practice, both sort of what specialist you're talking about and what their patient population is. So, for instance, adolescent psychiatry is going to remain dominated by telehealth, right? So the adolescent psychiatrists tell us the interaction of a patient of a 15-year-old kid in their own bedroom on their own device is way better as a clinical experience than having that person come into the office. So there's some places that are going to be 75, 80, 90% telehealth. You cannot stick a needle in somebody over video, right? So there's some stuff that's going to just have to be done in the office. I think primary care is likely to settle into a 20 to 25% range, but the whole pie might grow. So you're still going to come into the office for a good number of things, but you're going to be doing some other things that are remotely. And so I don't think it's necessarily should be thought of as an either or, right? This is a new modality that complement the stuff that's already happening. So if you have something simple, like I need a medication refill that I've been on, but I haven't come in to check with you, there should be a way to kind of get that done without coming into the office. I need a form filled out, and the kind of stupid stuff that people come to the doctor's office for, they just shouldn't do that. So I think that there will, the experience that we've gotten from patients is we've now had more than 160,000 patient feedbacks and forms that give us 4.9 out of 5 and an NPS of 70 plus, which in healthcare is just phenomenal. So I think patients will continue to demand it. I do think the regulatory and policy environment will allow it. And I think it probably settles out somewhere in the 20-25% range for most ambulatory practices. And then in the inpatient environment, it's going to be fairly present, but varies a bit based on kind of, again, what the need is and who you're talking about.
Well, that's a really insightful answer. So many folks are trying to prognosticate, I think, in a singular way, and your response around the types of care will drive, what's delivered remotely and what's not. So Stephen, there is a question here on blockchain for you. That's still a young technology, and given where your GMI sits in the market, it may not be something that you're looking at. But if you'd like to remark on that, why don't you take a shot at it?
Yeah, you're on it. We see less of that. It's a relatively emerging technology. And it sort of sits in this bucket of megatrends. Like I would think about it like drones. Yeah. Where there was a lot of funding that went to blockchain, I think in 2019, drones got a lot of money in 16 and 17. And it's great, it sort of builds an ecosystem for that style of technology that's really not in use today to find better use cases. But VR is much, much different than those. There are real business applications right now of, telehealth being kind of one of the main ones. But, you think about even, I mentioned that sort of remote technology or remote technician use case of like, there's software right now that someone can put an iPad in front of a machine that's, sort of being worked on, and the catalog of the machine will pop up. It will recognize the different, components in the machine, tell you what they're called, where you could order them. That's real technology right now. Blockchain is much more experimental. It's like, I guess to be succinct, there are business use cases, fully baked business applications for VR. I'm a little bit more of a skeptic on blockchain. It's more like people view it to be disruptive, so they're investing in it. That's a different, style of buyer than someone who's actually sees a business return on their investment in, telehealth, or, AI was also mentioned. That'd be another one.
Yes, Stephen, and so you mentioned VR. There's a question for you on the widespread adoption of VR technology in virtual training and data analytics space. So if you want to remark on what you're seeing VR and your investment work.
Yeah, certainly I would say training in general is moving towards a fully digital model. And I would start before you even get to VR to just e-learning, like sort of catalogs that are all moving online. The styles of sort of mobile apps that give you sort of fast, quick quizzes on the content for your work, for example. There's also, the compliance content is getting jazzier and jazzier. That's another thing that's sort of like people are, officially moving, all of that digital. So I guess, maybe just to put a broader thematic point on a lot of this discussion, it's there's a lot of walking before you can run on technology, and there's these long cycles that need to happen on things like VR, which I think we're getting into, and it's much further along. But even like you imagine one of the markets I cover, I mentioned supply chain, trucking. Trucking organizations can't think about blockchain because they need to still, like, some of them still need to get like their communications like into email from just being on the phone, or like they're running their accounting systems on sort of like 40-year-old SAP. And so there's just on the enterprise side, there's just such a wide gap, which, not to be, I feel like, a little bit, it's exciting to talk about the new technologies, but I think we have to level set around what's actually in use today and where there are practical business applications. But training is one where I would say VR is not as far along from what we've seen as e-learning and just simple online, course catalogs.
Yep. Yeah. Great, Stephen. So what I want to do now is we've got just a couple of minutes. If there's anybody on the line who would like to come off mute and ask a final question for any of our speakers, please do now. Okay, so it sounds like
Can we have them all back again?
Oh,
and I'll just say thank you very much for the time and for having me. This was a pleasure.
Well, great. Well, Stephen, Jake, Ethan, the diversity of your insights, the depth of your insights are all very much appreciated by this group. This was really a fascinating and timely discussion right after an election, ramping up on another wave of COVID, and all of us starting to think about our businesses, our organizations for 2021, a lot that all of us can take away from this. Before we go, I want to make a final plug for the NMTC for those that are not members. The Northeastern Maryland Technology Council is the leading technology advocate in Harford County. And if you're not a member, we want to encourage you and your firms to join the NMTC. And John Kasner, our board president, Claudine Adams, or myself would be happy to talk to you about membership. And to close, our next event will be early in 2021, continuing our new series, The Future of Everything. So we hope you will attend that event as well. So with that, thanks again, everybody, for joining us today. Thanks to our speakers, and we'll see you at our next event. Bye-bye.
All right. Thank you all.
Bye.
Thank you.